Welcome, everyone, to the first of a series of sector-focused Investor Academy events. Today we shall be discussing investing in fintech. My name is Camilla Sherbrooke. I am an Associate Director at Investec Wealth Management, and we are thrilled to be one of the Angel Academy sponsors. I'm joined today by Sarah Turner of the Angel Academy, and together we are delighted to introduce you to our three panelists, Nick, Hungerford, John, Elliot, and Kanika, Goela. Please feel free to post your questions in the chat function. We would like to kick off with asking you to post in the chat how you would describe yourself, i.e. an angel investor or an advisor. That's brilliant, lots of answers coming through. Great, thank you very much for that. I will now pass over to Sarah, who will be facilitating our discussion.
Thank you, Camilla. So I'm going to be chairing this afternoon's panel. For those of you who are new to Angel Academy, we're a network of angel investors. We back female founded and co-founded startups, 40 of them so far, and we introduce more women to angel investing. When we started in 2014, there were only a tiny number of women investing. The investor networks that did exist were purpose-built by and for men. So we created Angel Academy with women in mind. We're structured and organized in how we operate because women don't have much time. We're thorough because women are risk aware. And we're collaborative because that's how we become better investors. And crucially, we target female founders because they're still underfunded and underserved by the investor community, especially in less female-oriented areas like fintech, where we've actually seen a big increase in deal flow recently. But we aren't just for women. We have men investing with us, and we have sponsors like Investec supporting our mission. And today we have a fantastic panel of people from different parts of the investment ecosystem talking to you about fintech. I'm going to ask them each to introduce themselves. I'll then ask some questions to kick off our discussion, but please post yours in chat. So, panelists, John, Nick, Kanika, please turn on your video and step up to the stage, and crucially, turn your mics on as well. And perhaps starting with you, Kanika, can you introduce yourself?
Hi, everyone. I'm Kanika Goela. I've been with Angel Academy for 5 years and made my first angel investment through Angel Academy. So about me, I spent my entire career in finance. I started with consumer financial services. Then I moved to investment banking, where I advised tech companies on M&A and fund syndication. Then I moved to private equity, where I've spent the bulk of my career, and I've done everything from growth stage investing to large cap block purchases, as well as buyouts across multiple sectors. For me, as an angel investor, about 80% of my portfolio is invested in women-founded or co-founded businesses. And improving gender diversity on both sides of the table in the funding ecosystem is a personal passion for me. And my portfolio spans across the board, so not just fintech, but enterprise tech, health tech, travel and mobility tech, etc.
Thanks, Kanika. John, would you like to go next?
Yeah, hi, I'm a reformed management consultant turned banker. I've been with the Investec Group for about 10 years in total, and I look after our fintech and open banking partnerships. So I work with our technology communities inside the bank, where we're looking for strategic investment opportunities, but also work with our private equity groups across the different geographies that we operate in. So the UK, South Africa, Israel, India, and some other Asian geographies. I think most recently, the most interesting transaction I've done was I led the transaction for Investec to take a minority stake in Monese as a strategic venture and execute on moving our transactional banking capability onto their platform, utilizing their banking as a service platform. So that's sort of the angle in life I have.
Great, thank you. And Nick? please introduce yourself.
Thanks, Sarah, and hi, everybody. Hope you can all hear me. I've got a bit of a sore throat today, so I promise technology is not advanced enough for me to pass it on to you. But if you can't hear me, just let me know. I'll speak up. I started my journey out as a teacher, then moved into banking, and then after getting my MBA from Stanford over in California, started Nutmeg. Nutmeg is an online investing business. We focus much more on the public markets than the private markets, but I've always been keen to follow developments of what's happening in private companies and how how people can build and accelerate companies through the journey all the way through from an idea. And obviously that's what I did with Nutmeg. And then in 2018, as I left Nutmeg, became a partner in a private equity venture capital firm. So we invest globally in fintech businesses, and happy to share my views on the differences between fintech and the general environment as well. Done about 30 angel investments myself across all sectors, but mainly in fintech, probably about 25 of those in fintech and 5 outside. And other than that, do a lot of private equity work as advising and helping out with fintech stuff. So really delighted to be here, and thanks for inviting me.
Oh, thank you, Nick. So perhaps starting with you for the first question, something about timing. It feels like fintech is going through even more of a boom than it was previously. So why do you think this is the right moment to invest in fintech, or isn't it?
I think it's very hard for students of history to get to put aside the nerves when valuations become higher than they have been previously, or when new technologies come on the scene and it looks like they're getting valued at what seems like crazy prices. But there are plenty of examples when we look back to see that actually companies that once seemed crazy could be picked up at bargain prices. I mean, you just look at Apple and Amazon and other companies when they listed, and you might think, oh gosh, that was expensive, but it feels like nothing to us. Facebook listed at, I think it was 55p and went down, or 55 cents and went down to 30 within a couple of weeks. Someone will probably correct me on my numbers, but it's now close to 250. So everything can get crazier, and we just have to think about moments in time. And I think the fintech story is really one of a massive realization that life is about to change for so many people. Future generations, existing generations, aren't ever going to use coins and notes, right? They're going to pay for everything on cards or watches or wristbands, or probably through a chip in their arm soon enough. And we're not going to need to make difficult financial decisions because we'll have automated advisors doing it for us, before we get a chance to make bad decisions. So I think everyone has now seen that that's coming and seen that it's real. So the difference between when I started my company and what's happening today is just that realization, really. And if you believe that, and if you're on board with that change, then today's valuations can still look pretty cheap.
John, Kanika, anything to add to that about timing? It's very reassuring. Thank you. We worry about valuations, but it's good to hear that.
Yes, I think from a financial institution's perspective, the opportunity to invest now presents you with strategic optionality down the line. When I say we, it's a challenge we have as an institution, and I'm sure most other institutions have it. We don't have the ability to act as quickly and as nimbly in the marketplace as startups do, and we are far more constrained by protecting existing lines of business, existing revenue streams, and we're often in a more regulated environment. But the external market has moved on. Regulators have come to the party. They've created a safe regulatory environment for these firms to start up in. And we know that we're not going to be able to build as quickly ourselves. But what we do have as an incumbent is we have trust from our clients. We have an enormous amount of expertise in terms of managing regulatory and compliance. And we have existing distribution capability. And for us, the type of optionality that we get out of investing in fintech is significant, because it helps us future-proof ourselves for what's going to come down the line. Because as Nick's pointed out, we know that the world isn't going to look the way certainly the way we grew up.
Nick, your hand's up. Did you have a?
Well, I know John will take this in the spirit in which it is meant, but I think that Investec lacks any experience, I'm grossly exaggerating, in regulation and compliance in the new world. And this is one of the great reasons why fintech has a chance to succeed and the valuations are where they are, right? It's a new way of thinking. And you take companies like Revolut, and they break every barrier, and the regulators can say, blimey, like you're doing everything. And then they pause and they're about to say wrong, but they realize it's just different. So I'm not being mean to John, but just for the sake of debate, I think it's an evolution.
Yeah, you're right. And it's a mix, because we don't have expertise in doing it in new ways, but we have a lot of expertise around the existing ways. And that's why we can't do it ourselves inside our own shop necessarily. That's why we need to look outside. But we do have expertise in other areas, like deposit taking, as an example, right? Where most fintechs don't particularly play in the deposit taking world, as an example, or managing more complex client entities. So yeah, I agree. We will agree to agree.
And Kanika, from an Angel perspective, do you have a view on timing? Why now? I know you've recently made a couple of fintech investments. So.
Yes, so sorry, so I'm not an angel, not a thematic investor, as I said. So I invest across the board, and I feel that what can be said for fintech, Nick, the point that you made about the world changing, and John, the point you made about strategic potential in the future, that could apply to other industries, for example, health tech or clean tech. It could apply to other areas as well. But so for me, I'd look at every idea on the merits of that idea and whether the timing is right for that problem, and how they're approaching solving that problem. But from European perspective, I'd like, because I invest a lot in the UK, I do feel like if you look at the macro and how the European late stage funding ecosystem has been compared to, say, for example, the US, and how much money has been raised, etc. in the past, there's still a lot of huge gap between where Europe is versus where the US is in terms of late stage fundraising. And over the last year, where Europe has changed, suddenly, we have, I think, 72 new unicorns which were created in the last year, and Europe has finally overtaken China in terms of the number of unicorns. So there's a lot of fundraising interest now in the market out there. So I feel that as an angel, that kind of helps, because if you feed the top of the funnel, there's more investment interest later down the line as well. So I think that bodes well in terms of timing as an angel. Okay,
and just sort of digging a little bit into specific theme areas, Nick. So John, you've already mentioned monies. Are there particular areas where you're looking for investments or partnerships? And same question to you, Nick, as well. John, if you want to start.
Yeah, so from our point of view, we're looking for opportunities that can either significantly enhance our existing shop, or allow us to build new adjunct businesses that leverage our existing distribution or premium financial services brand. So we don't want to stray terribly far from where we are, but we are looking for opportunities to grow breadth and depth. And that could be either new product sets, or it could be access to new markets that we aren't able to get to currently.
And just some sort of specific examples? What?
So specific examples, at the moment, we operate, say in the South African context, we operate in a largely private banking and high net worth only world. We have one of the best financial services brands in South Africa. How can we find a way to partner with a lower cost delivery platform to access a different slice of the market that we haven't gotten to yet?
Okay, that's really helpful. That's going to be thinking there. And Nick, how about themes Portage is interested in, and you personally as an investor?
Yeah, for Portage, we cover 4 main buckets, which are insurance, banking, wealth and asset management, and then payments. And then around that, we cover the infrastructure to support all of those, so B2C and B2B, and then anything else that we might cover, which is crypto or something like that, which might help with those particular sectors. So we're always looking for deals there, and we do that globally, not through India, China, or Eastern Europe, or some of the Southeast Asian countries, but otherwise in most countries. And for myself personally, I'm looking for 2 things. One is great founders with a good idea and a passion for solving a problem in a big space, and that's financial returns driven. And the other one would be for people who are changing the world of investing with a mission that is both financial but also socially driven. So just talking to a couple of entrepreneurs this morning, Sarah, who I know I've introduced you to before, building a stealth product which would solve John's problem precisely. They're inventing, they're 2 females inventing a new financial product, which I think will change the way that people for decades to come, generations to come, save and invest. And as an example of what people can achieve, they set out to raise £1 million. Two ladies based in London, one's from Trinidad and one's from South Africa. And they ended up raising in their seed round 2.6 million from 5 global VCs. And a bunch of angels, and then we all actually got squeezed out of our allocations because there was too much oversubscription. So that kind of deal is great for me because it's mission driven, as well as I think has potential to change the world and drive financial returns. Perhaps I'll pause there.
Thank you. And just sort of staying with you for a minute, Nick, what stage are you? Sort of, understand sort of the angel stage, but at Portage, you're not a typical VC in that you're doing post-Series A. You're now doing some seed stage investments, aren't you, with Portage, and pre-seed even?
Yeah, we do about 25, or we will do in our new fund. New fund is 750 million. We'll do about 20 to 25 seed investments, and really that's just to understand and get a foothold in some of the most inventive ideas like the one I just described. Excuse me. And of those, we'll probably go on to back maybe 6 or 7 of them with further capital, because they're super high risk and an early stage. The later stage ones at A, B, and we'll do the occasional seed deal and more checks of £5 million to £50 million. And those ones we look at risk reward in a very different way. I think, as some of the comments have already touched on, though, the whole capital market stack is getting squeezed at the moment, and we have public market investors doing private stuff and large private market investors doing early stage. So we, as a middle stage fund, are doing much earlier. And then angels, to the question, I saw one question in the chat. Angels have to compete to get in those deals, whereas before it was fully exclusive. Now people like Portage are fighting for that deal share in the seed rounds as well.
And building on that point, how do you work with angel investors? So Nick, John, obviously, Kanika as an angel yourself, we collaborate with other angel investors, don't we, and some VCs. But Kanika, do you want to talk about that journey and some of your recent investments?
So yeah, Sarah, I think you pretty much know my model, because it is the Angel Academy model. So I have made investments outside of Angel Academy as well, but my preferred model is definitely to partner with other angels. Also partly because one, I can't write as big a check size to make a meaningful dent in even a pre-seed fundraising. But as an angel, I find having the intellectual the leverage of harnessing the intellectual capital of the entire group is very, very useful in making early stage investment decisions, because you don't have any history. You're really looking at the future and the team and the idea that they're solving. So yes, working collaboratively in making the investment, and I find that helps follow on as well, right? In just portfolio monitoring, etc. Otherwise, as an angel, where you're looking to make at least say 30 investments to have a well-diversified portfolio, it just really gets too much for an individual to handle, especially if you have another day job.
And do you feel yourself squeezed out by funds coming in earlier? I mean, my pushback to that would be there are more opportunities than ever. So actually, even though there's more capital chasing these deals, there are more deals. So there is still room for everybody, and actually we need to grow the investment capacity, don't we? But
yeah, absolutely. But there is definitely, I see that increasing competition across the board. And I think VCs earlier had to distinguish themselves and, have a clear value add. And I think that's going to become more and more important for angels as well. Especially, yes, there is no shortage of deal flow, but, some of the really highly compelling stuff or at an early stage, you'd find there's plenty of competition out there.
So Nick, what would you say to angels about how we compete against VCs?
Well, I think most angels will find themselves working with VCs. I mean, if we're being honest, it's a two-way symbiotic relationship that works if both parties are doing it well. VCs need angels to help them scout deals and find the best companies and for their specific expertise. So if someone has an expertise in X, then we as VCs need their expertise to help us understand if it's a good company. And then angels need VCs for the capital. Ultimately, we bring usually larger checkbooks than most angels. So by injecting our capital, we de-risk the investment quite considerably for angels. So it doesn't always have to be a competition. The reality is that the hottest deals, everyone wants the most allocation, and then it is competitive. But I promise you that the hottest deals, when it's an idea on paper, often turn out to be the least hot deals 3 years later, and the ones that no one wanted turn out to be the big ones. So
I was going to say, I think there's some self-fulfilling prophecy, isn't there, that because a lot of people are chasing a particular deal, it's as you say, not necessarily the hottest, it's just the one that's captured the imagination for some reason. So we're very good at finding the overlooked ones, I think, but then then we need to be able to sort of create some kind of competition from others to get into those deals as well. And John, do you see angel investors at your stage at all, and do you collaborate with us?
Where we're investing on behalf of our clients through our funds, we do sometimes act as an angel investor ourselves. And I mean, I think, as Nick was saying, it's very much a symbiotic relationship between larger capital providers and angel investors. I think when we're looking to invest for strategic purposes, one of the things that you always do want to look at is who's on the cap table and the quality of the angel investors and their investment track record behind, and their ability to access their own networks to unlock value in that firm is quite important. And we do look at it then. But we certainly don't operate in a world where we want to squeeze out angel investors. Angel investors are an opportunity to bring more value into the firm, but selfishly, you want to make sure that they're the right angel investors.
Okay, thank you. And Nick, you mentioned ESG and social impact as part of your investment strategy for your personal interest. Is societal impact something that Fintech can deliver Is that something that everybody considers as part of their investment? And is there anything specific for female founders as well?
I'm not sure that everybody considers it for their particular investing, and I wouldn't presume to be telling other people what their strategy should be. But I certainly think fintech can play a massive part in doing good for society, whether it's environmental, of reducing waste and the cost of transactions and lots of publicity around Bitcoin mining and stuff like that, or whether it's social goods. So probably the thing I'm most proud about with the Nutmeg journey is that we've got nearly 200,000 people investing, and some of those were investors before, but a lot of them weren't. And moving money from cash into investments, whilst it might be a bumpy ride, will probably make a substantial difference to those people when they retire or want to buy an asset with their proceeds. And we've done it in a way that's fair and transparent and demonstrates fees. And I think we have really turned the industry from one that was known as opaque into one that is now much more transparent and trustworthy. And so I believe that fintech can force those changes. It can force people to do things better, but it's not just, that's not just a trend of the last 10 years. Like, for every company that was started 50 years ago, it was an adaptation and improvement on things that were started 200 years ago. And we have to remember, finance started, at the dawn of time almost. So I think we see that consistently, but this is a new stage and a new level and forces everyone to behave better. And I do think that pioneers and entrepreneurs of fintech will be some of the biggest influences around, especially in the UK. And if they come from a generation like mine, woe betide any government who wants to mess with that, because we will just start our own party and blast you out the water with all the money that we're making.
Kanika, I know ESG is a strong component of your investment portfolio, but can fintech be a ESG and impact investment as well?
Absolutely. I think the power, of firms within the fintech field, which could be, finance as a horizontal function or finance as a vertical service, is incredible. So I think both of my fintech investments of late have been in areas where there is some impact. So one was, this investment I made through Angel Academe, which was reducing behavioral bias in investment decision making and targeted towards the active fund management industry. And I guess just being from the industry, an area that really spoke to me, because there is a lot of bias, and that bias sometimes happens because the gender that gets in the field, where you're recruiting in the field from, and the overall culture, for example. The other investment I've made in India, which is actually improving lending into the agricultural sector and really bringing people who did not have credit history and actually lending to them. So I think there is a lot of power to address ESG issues through fintech.
Excellent. Okay, and then Nick, you mentioned previously sort of murkiness and lack of transparency. So I just wanted to ask all the panel about their thoughts on blockchain and crypto. That wasn't meant to be a leading question, but it did follow on. And then we have got some questions coming in to chat, but please keep adding them and we'll get to them in just a moment. But Nick, would you like to kick off on that one? Is that an area of interest for you or Portage, and what are your thoughts on it?
Yeah, absolutely. And I think that there are so many exciting applications of decentralized finance and use of the blockchain that we're seeing that have a social purpose. I think it's really cool that you can take your coffee and scan the barcode and see where it came from at every stage of the journey, and that supply chain work, as an example, will be, I think, incredibly productive to help us understand where our responsibilities are in that respect. But there's also a bunch of stuff which, you know, probably people going over the top with making stuff that doesn't really make much sense. But you know, I struggle with some of it. So let me give you an example. I don't really have any cultural bones in my body. I like kind of sport and work and friends, but that's it. When you sort of take me to the opera or the ballet, I become very uncomfortable. And so I have no sense for art, right? So I literally do not know anything about art or have an interest in anything arty. And so for NFTs, when people say, oh, they're a complete waste of money, non-fungible tokens of whatever people decide to draw digitally, I'm like, yeah, but how can you say that's a waste of money when you're paying 60 million for that painting? So I think there's a lot for me which is yet to be explored in this. I think cryptocurrencies are exciting because they lead us to digital currency, which we probably need for states in terms of eliminating money laundering and collecting tax effectively and all that kind of stuff. But I think independent digital currencies are a bit of a stretch for me. But next view.
You mentioned, sorry, I was just going to say, you mentioned supply chain traceability. So we have a company in our portfolio that quite a few of us are invested in called Provenance, and they're doing exactly that with the blockchain. So actually the blockchain investments we have done have been non-financial applications of the blockchain. Sorry, John, I interrupted you. So
I was jumping in. I'm exactly where you are regarding central bank digital currencies. Over 50% of the world's central banks are currently looking at central bank digital currency in some way, shape or form. And that is going to transform payment and how we move money around. Right? So that is very exciting. I'm in the same movie about sort of independent digital currencies. And I think the regulators are going to move to squash those pieces out. I think what is coming though is because all the world's central banks are going down this direction of travel. There's going to be an increasing skills crunch in the space. Suddenly every bank and every financial institution is going to want to start hoovering up people and skills in the space to meet their own ends. Along with everything else that's happening in the blockchain universe, it doesn't feel like there are enough skills in the market globally to solve the need that's going to land on our laps within sort of the next 18 to 24 months.
Thank you. Anything to add, Kanika? You?
No, I absolutely agree. I find blockchain fascinating, but just haven't been able to understand enough to be able to press the trigger on making an angel investment in that space, and cryptocurrencies, yeah, to stay away from personally.
So moving on to the questions coming into chat, we've had one from Goela, so possibly related to blockchain and crypto, but she's talking about quite a lot of scandals in fintech. So how do we evaluate the regulatory risks and the maturity of the approach? Anyone want to take that?
Well, I mean, there are scandals in fintech, but show me an industry where there aren't scandals. And then there will be a few changes and rules broken as we innovate, and there will be a few bad apples. Unfortunately, that's the nature of human beings. But I don't want to stand and say it's not going to happen and people aren't going to get hurt. That just wouldn't be true. But I think we have to put it in the context of, what are those people trying to do, and did they start off with a good mindset, etc., etc. But the point is well made and well taken, and anything we can do to try and eliminate it, the better.
Anyone else want to come in on that?
I don't think you can ever eliminate the risk. If you eliminate the risk, it means you're not pushing boundaries hard enough or fast enough. It's about being proportionate, and that's sort of the view that the regulator takes as well. So you do the best you can. You understand what the mission is. You don't do business with people who you don't align on what their mission is. Right? You should never sell a product that you're not proud to sell your grandmother. Otherwise, you shouldn't be in business. And make proportional decisions, understanding that many firms are in different stages of their life. How you treat a wire card when it just started versus how you treat a wire card when it became the size of business that it eventually grew to should be two different things. So it's not you can't take a one and done approach. You have to continuously evaluate. Especially as a regulated institution, you have to continuously evaluate your own reputational risk that extends to the people you've invested in.
Thank you, that's a great answer. Question from Paul. He's saying that there are some obvious significant exceptions, but a lot of fintechs in the UK have struggled to develop sustainable business models. Do you sense that many are looking to be bought by an incumbent to solve their own technology problems, and the business model is therefore less of a driver?
Want me to talk because Nutmeg just got sold to an incumbent? Well, it wasn't an incumbent, they're not here yet. I think the question is naturally written with a view in mind of what a sustainable business model is, and we need to reframe that in today's world. A sustainable business model is one which can raise capital. It's not one that's profitable. It's not one that has the metrics that maybe Warren Buffett was looking for 50 years ago. The reality is that people are happy to run businesses where they make losses years on years on years. I think it was 25 years before Amazon turned a profit, for example, because they can raise the capital to do so. And it is a bit misleading, some of these losses and some of these PR articles about oh, so-and-so made a loss this big, or so-and-so made that's pure choice. Like companies can be profitable pretty early if they turn off their marketing, or if they wanted to stop growing so fast. So I'll assume the question was asked in the spirit of, do people want to get bought, rather than the business models are rubbish, because I think that's a debatable question. In terms of people getting bought, it's an exit route. So's IPO, so's ICO, so's merger, whatever. And there's no reason to do that. If it's venture backed, then they can exit in 10, 12 years or less. But I suspect, we'll be sitting here in 20 years' time saying that fintech bought the incumbent companies rather than the other way around. Reflection.
I suppose business model tends to be of more concern to angel investors. We're writing smaller ticket sizes. We can't maintain these companies. So it might be just a key. It is more of a preoccupation for us. Would you say that's still wrong then, or?
Look, I think when you're an entrepreneur and you start a company, you have to decide what you're starting the company for. Is it a consultancy type business where you want an income and you're happy to run the company forever and get that income, or are you do you want to be a fast growing venture backed company and try and push to change a lot of lives and make a lot of money? And the answer to your question lies within that choice, really. But that's down to each founder, I think.
I think there's a lot in between, isn't there? There are a lot of kind of companies that can achieve a modest exit and a good return for angel investors, and those are probably the ones that have a business model from the get-go, but they might not be the obvious ones for venture capital companies to play in.
But then I'd say to you, why are you investing as an angel in that? I mean, if you think it's got a social mission and you want to do it because you're a charitable person, that's great. But like, I'm sure, as you know, I'm being a little bit provocative for the purposes of this panel, but like, why would you invest in someone who says I'll make you 2 times your money when you can invest in someone who says I'll make you 200 times your money?
Kanika, any thoughts on that as an angel? We look quite carefully at business models, don't we? We understand that, for some it's going to be working it out a bit later, but some of our investors certainly are quite concerned with that.
Yeah. So I think it varies across the board. For me personally, again, I'm willing to take that higher risk. So for me, the kind of investments I like to do are definitely the ones that could be backed by a venture capitalist firm in the future, kind of the big opportunity ones. But given my private equity mind, I do need to see that path to a sustainable business model. Now, whether you choose not to turn, to go aggressive on marketing and actually, have losses for a sustainable period of time, that's fine. For the foreseeable period of time, that's okay as far as I'm concerned. But just some sort of visibility into the market that translates into potentially lifetime value of a customer versus cost of acquisition. And in early stage angel investing, it's really difficult to have visibility on that, obviously. But it's something I like to think about and think of a sustainable model for the future. But Nick, I find it that you said these days sustainable to raise capital and not profits. But at some point that the profits have to come, right? To get exits, viable exits.
Oh, you must go to Silicon Valley, the sitcom on YouTube, and watch the clip about revenues. It's 2 minutes long and great. But no, profit doesn't have to happen. I'll give you an example. You're a data company, and you are building complex algorithms to track something happening with an object that moves around in a bigger environment, and you are running this, and you're by building this because your private equity investors said it's a huge market and we can apply it to shipping and we can apply it to supermarkets or whatever, right? So you're doing this thing for 5 years and you've got 500 engineers and whatever. You can be completely unprofitable, right? And you can have no path to a sustainable business model because you don't sustainable being profitable because you don't have any desire to stop building this thing until it's perfect, right? But if Tesco come and buy that and they apply across all of their supermarkets, is instant profits by 40%. The company doesn't need to have a business model that works. Where I totally agree is it needs to be building into a big market, and it needs to be something that people that solves a need for people, B2B or B2C or whatever. But we've got to, in the current environment where interest rates are low and capital is easy to get, we've got to come out of this mindset of a company needing to have a business model to survive. If you have if company needs to be profitable, if you have a view that the world is going to crash and interest rates are going to 10% and all capital is going to dry out, then sure, you look at investments in a very different way. And when you're investing as an angel or as a private equity investor, you need to provide yourself with protections, anti-dilution, co-sale, etc., that other investors have. But for today's world, and it's weird, I get it, like it's weird, but for today's world, being profitable is not a necessity, and having a path to profitability is not a necessity. And people are going to lose out on money if they think that they need to have that.
So, John, do you want to? Oh, sorry, Kanika, you were coming back.
No,
I love this. This is
no, it's really interesting. So I guess the takeaway, and we do look at it in our angel investing as well, Sarah, at least the group does, is that you need to be building something valuable which someone can use, right? And it has that competitive moat. or a network effect, which is going to give someone supernormal returns, if not you, if not in that current business model context, right? So point taken on, if it's building something valuable that can help someone make money, it doesn't have to be them, just that company alone. So.
John, do you want to come in here as a strategic investor? What?
Yeah, I think the point is it's economic value creation. It doesn't necessarily equal profit. I think the one thing that we do look at as a strategic is the underlying risk in that model to ourselves as an organization, especially when you are taking on an investment to consume services from that firm. Not only are you now betting the farm on the quality of the services that you're getting from the firm, but you're also writing the equity check, and you are effectively underwriting the future execution risk in that firm, because you don't have the luxury of allowing it to fail. So we do look at the business model quite carefully as a strategic investor from that point of view. And we want to know that there is a very clear path to profitability, so that when the music stops, we aren't sort of the people holding cards.
Okay, excellent. It's a really nice, thorny issue. Excellent. I'm now going to move on to Tracy's question. She is asking about the next hot themes in fintech, and in particular, what will make a real difference and impact on businesses and people. So, hot themes, what are you thinking? Kanika, I'll pick on you. What? It can be a personal interest. So
hot themes in fintech, was that the question? So I honestly do not have a hot theme in fintech. I think anything, just technology has the power to democratize access to certain services, or what have you. People who did significantly low costs of providing that, and so that's something of interest to me. But honestly, I don't have a hot theme that I can say, hang my hat on at the moment and say that that's what I'm looking for.
Technological disruption, that's a pretty hot theme, isn't it? How about you, Nick?
A couple looking at, so, I keep stressing from the personal side, I think we've got an awful lot to do on saving and investing and transforming that. Like, it still amazes me that people believe that a mortgage is an effective way to invest. I mean, blows my mind. And saving, obviously, at the moment is just not a happy situation with interest rates so low. So I think there's a lot of innovation in there, which is good. Aggregation of data, I think, is finally going to show some teeth. So we've seen a bunch of aggregation products over the last 15 years in different sectors. Finally, we're seeing pensions being able to be aggregated. Insurance, I'm sure, will follow soon. Open banking. There's a lot there which is going to help consumers and really make a difference to people's lives in terms of knowing what they've got, what they haven't got, and seeing the implications of that. And the third one I would say would be finance as a service. So allowing non-financial services companies to easily act as banks, or have their own card, or be an investment product, or buy and sell Bitcoin, or whatever it is that they want to do. The infrastructure layer of financial services trade changed even in the last 18 months dramatically, and that's big.
John, how about for you?
I won't take away anything from what's been said. I'd add on to, as it's not an immediate opportunity, it's a longer run opportunity, is DeFi space. It's going to be transformative to financial services. We do think a space that is going to become increasingly visible is the climate ESG space. We're seeing a lot of activity, not just on the sort of thematic investing side, but also on the side around enabling financial institutions to have a lot more transparency around the actual climate impact of what their balance sheet activity is doing. So who we're funding, what that money is being used to do, and how do we create transparency back to regulators, investors, etc., around the type of activity we're undertaking. I think that's part of a broader global push around climate tech that you're seeing across the board, but it is bleeding into the fintech space because with banks being so highly regulated and investment firms being so highly regulated, they feel like they're easy targets for regulators to start pushing the execution of climate agendas.
Okay, excellent. And I mean, likewise, I think on the consumer side, lots of propositions I'm seeing which enable consumers to be have more information about where they're spending their money, the climate impact of their purchases and things like that. So yeah, it's happening on both sides, isn't it? Right. Okay. Any more questions coming? I wanted to ask a wrap-up question. So, you know, thinking more kind of personally about your own investment preferences. So where are you putting your own money right now? Who wants to start?
Besides into my mortgage.
Yes. Well, you're running the risk of being told off by Nick.
Yeah, I guess the most recent investment I made was a small investment into Curve, they're building a one card to rule them all financial services product that runs over the top of all of your existing banking products. They're expanding into the US. They've done some amazing stuff with Samsung Pay, and indirectly a fund that invested with we also had a stake in them through that for fullness. But yeah, that's my most recent punt.
Okay, so that's a consumer fintech card. So yeah, okay, got it. Great. Curve, watch this space. Kanika, what about you?
For me, the one theme I'm pursuing at the moment is clean tech. So alternate proteins, future of food is something I'm very interested in.
Excellent. All right. So not a fintech answer at all. And how about you? How about you, Nick?
So I think the ones I've done in the last couple of weeks are a business that helps companies that are ongoing that wants to provide liquidity for existing shareholders, and particularly in the EIS world, and for angel investors, I think that's really important. So the business started off with I want to be $1 billion business, and is now like, look, we're not going to get it there, but we're quite enjoying it. So the angels are like, well, can I get out, please? And I'll take my profits, but I don't need to be a shareholder anymore. So I like that one. That's pretty cool. That's called Plan D. Check that out. Circular, which is a business in Singapore, which is trying to be a social version of buy now, pay later, which is a whole nother subject, but not my favorite one. Not the finest hour of financial services, I don't think. But Circular, what it does is reinvents that by allowing you to rent products rather than buy them. So it's very environmentally friendly. And at the end, if you rent your iPhone for months, then you give it back to Circular, and they give it to someone in the country who's willing to pay for it. But obviously secondhand and much cheaper. And then you get the next edition. So it's meant to be an ESG rental company, and I think that's got massive legs. And then the third one, so I don't want to bore you forever, but the third one I'll just mention is a company called Solve in the US, which is the first debt robo-advisor. So what assets are, we'll analyze them and tell you how to optimize. But Solve is like that's what your debts are. So open banking to get your accounts and add up your debt, and then they say press this button, and then they reduce your debt or they reduce your interest rates or whatever, which I think is really cool.
Excellent. Thank you, everyone. I think I've written a few notes about the companies you've mentioned, so I'll be looking those up later. Thank you very much for participating today. We've run out of questions in chat, so I'm going to let you all go. I know how busy you are, but it's been a fascinating session. Thank you, everybody online, for joining. Please have a look at our video more about. We're all looking for founders to open on our website, and we will be posting a recording of this session to YouTube in the next few days. So look out for that, and there's also lots of recordings of our other events. But enjoy the rest of your day, everyone. Thank you. Brilliant session. Thanks, everyone.
Thank you.